problems, short-term loans. Now we've seen some market stabilization yesterday. Some economists say this could be a correction, a recession, but not a depression. What's your reaction to that?
I don't think it makes a lot of sense to predict the long-term future, but what we're having right now is a short-term dislocation in the credit markets. The stabilization you saw yesterday in the stock market does not reflect necessarily what's going on in the credit markets. They remain troubled, and that's where the folks in Washington are trying to focus a measure that will address that problem and relieve the freezing in the credit markets, which is a significant situation. I don't want to downplay that. But if we move through that, then there's no reason why businesses shouldn't continue to function and the economy regain its footing. But right now, the short-term situation is severe. It needs action from Washington, and that's why all eyes are on the Congress right now to pass some sort of package that will unfreeze the credit markets.
Rich, could you explain simply for people like me who don't understand it, why are the state investments safe when everybody else's investments, including my 401k, are going to pot? Could you explain that?
Your 401k, Alan, likely is invested significantly in the stock market. A diversified portfolio pretty much tries to be invested in all aspects of the economy. Because of the short-term nature of the state's portfolio, that is, our money moves through quickly and is spent. It does not make sense for the state to be invested in stocks, which bounce up and down, unpredictably. We want our investments in shorter-term instruments with more specific and safe returns, so that we don't risk potentially losses in the stock market one day and then having to have the money to spend the next day. So by law, and certainly if it were not the law, it would be our policy, we don't invest the short-term monies of the state in the stock market. That's the main difference between the two. Then, as I said, within the parameters that we're given by law, we have choices we can make. We have chosen not to be in mortgage-backed securities. Some people might have described that early last year as stodgy, but in the end, safety turned out to be the best course. We also can invest in commercial paper. We have maintained a watch list in the Treasury for the last now about 16 months, ever since the first problems arose with Bear Stearns, and we have had certain of those financial institutions, investment banks on our watch list, meaning that we were not investing in them while we saw their troubles unfold until we were clearer about them. At different times on our watch list have been Bear Stearns, AIG, Merrill Lynch, Lehman, and we did not end up with any exposure to those companies that have been hurt by the market developments in the last month in particular.
So the state money is invested in what kind of things again? Could you give me a few examples, perhaps?
U.S. Treasuries, U.S. bonds, agency bonds. This is an important distinction. With Fannie Mae and Freddie Mac, the events of the last month have hurt shareholders in Fannie Mae and Freddie Mac. Again, if you own shares of stock in Fannie Mae and Freddie Mac, you're close to being zeroed out on that investment. And there are a lot of investors who've been hurt by that. If you own bonds issued by Fannie Mae and Freddie Mac, and the state has significant amount of bonds, those actually have appreciated in value because the federal government has now made clear what was always considered to be the case but was only implicit before, which is that the federal government backs Fannie Mae and Freddie Mac bond issuances with the full faith and credit of the U.S. government. So they are now indistinguishable functionally from Treasury notes and Treasury bonds. So that's important to understand as well.
Can we go back to the commercial paper for just a second?
Sure.
Who is the closest, what paper do we have right now that may be in peril with what's going on? And why not just dump that paper at this point with so much turmoil on the street?
Well, we don't have any paper that we think is in any imminent danger. We have been shying away from commercial paper issued by financial sector companies for some time. They're obviously showing weakness, and they are in fact the source of the weakness in the stock market and of course in the credit markets. But in terms of companies, a lot of companies are doing just fine right now, especially companies that have significant presence in the export markets and the like. Looking forward, we have to get this situation under control to maintain the fundamentals of the U.S. economy, and that's why people are right now, sort of watching very closely what's going on in Washington.
Just for clarity, the trade-off being a little higher yield, and do you know what the percentage of our portfolio is in that?
It's a very small percentage of our portfolio in commercial paper. It'd be less than 5%, maybe less than 2%. We can get you those numbers afterwards. And by law, we are only, and corporate bonds as well, we are only allowed to invest in the top-rated corporate bonds. It's only about a dozen companies in the United States. And we've been light in those sectors because we have felt that it was prudent to put the vast majority of our money in the safest investments. And in fact, some of our investments have benefited as there's been so-called flight to quality, as people who had been invested in riskier investments are now coming to seek the safer investments, which boost their price and therefore boost the value of our existing investments that we already had held prior to that happening.